Business use of your home. Generally, you may deduct business expenses that apply to a part of your home only if that part is used exclusively and for a regular business purpose. So if you wish to claim a home office deduction, you need to show that it's necessary to have an office in your home and that the home office area that you use for your business is exclusively used for that purpose and nothing else. So you are allowed to claim home office expenses only for the part of your home that is used exclusively on a regular basis, and it must also be your principal place of business for any of your trades or businesses, or it must be a place of business used by patients, clients, or customers to meet or deal with you in the normal course of your trade or business, or it must be in connection with your trade or business if it is a separate structure that is not attached to your home. There are two exceptions to the rule of exclusive use of your home. The first one is inventory storage. So maybe your home office is not used exclusively for business use, but you use it for storing inventory. IRS then says that's okay. Or if you use the home to operate a daycare business, then that too can be accepted from the 100% exclusive use rule. So let's just suppose you're in Amway sales. At some point, we're always going to have a client in our career who is doing the direct marketing, right? And so they like to hold a party at their home and invite people to present the Amway to them. And they hold that party in their living room or in their kitchen. And are they going to be able to deduct home office for that space? And the answer is no, because they're not going to be able to show its exclusive use. But if they do maintain a separate room in the home that is used exclusively for the business, then they would be able to deduct home office for that room as long as they can show that it was exclusive for that business. So principal place of business. In order to deduct home office, you have to show that it is your principal place of business, and your home will qualify as your principal place of business for deducting expenses if you meet the following requirements. Number one, you use it exclusively and regularly for administrative or management activities of your trade or business. And examples include billing customers, clients, or patients, keeping books and records, ordering supplies, setting up appointments, or forwarding orders or writing reports. And you have no other fixed location where you can conduct substantial administrative or management activities for your business. If you are allowed to deduct home office expenses, you need to complete Form 8829 and enter your expenses on the form. And then regarding continuing education, is the cost of attending multi-day tax seminars fully deductible? I would say absolutely yes. If you're a tax practitioner or a CPA and you're traveling even to the IRS practitioner forums and you're there for several days, absolutely that's going to be deductible. And have you ever noticed that the IRS likes to hold those seminars in places that are going to attract interest? Well, the big one I can never understand with the IRS conventions is they hold them in Las Vegas in the month of July or August. It just seems to me, if you want to get people to go to Vegas, that they would hold them in December or November when the weather is cold everywhere else and Las Vegas is still warm. But at any rate, that seems to be their biggest turnout. Las Vegas is the number one place or the biggest convention that IRS has. People come from all over the country to attend conventions in Las Vegas with the IRS. And yes, that would be totally deductible if you can show it's for your work. But you'd also have to look at when you arrive and when you leave. Do I arrive in Las Vegas on Wednesday for a convention that starts the next Monday? That would be pushing the envelope. If I arrive in Las Vegas on Sunday for a convention that starts on Monday and it runs Monday through Thursday and then I leave on Friday, and I'm at that convention for 3 to 4 hours a day because that's the length of time or the number of classes I wish to participate in, then you would be able to write off that whole trip, except for personal side activities like going to a show. Oh, it's cheaper during the summer? Well, I guess that would make sense. So IRS obviously is not going to hold a convention in tax season, and so it does hold them over the summer. The only one I've ever went to was in Anaheim back in 1997. Haven't been to one since. All right, so we're moving on to the home office expense deduction, and let's just take a look at the home office form. So the IRS, in the instructions for Schedule C, repeatedly over and over again says, do not enter on Schedule C, on any of those expense lines of Schedule C, anything that had to do with maintaining your home. Utilities for the home, taxes for your home, mortgage interest for your home, none of that belongs on Schedule C. If you meet the tests for claiming business use of home, then you need to attach Form 8829 to your return and fill it out on the correct lines, entering all of the expenses you have that correlate to each line. So we're going to take this form and actually look at it pretty closely. And 8829 is divided into several sections, just as Schedule C is. And we're going to start by looking at Part 1 of 8829 here. You use Part 1 to determine the percentage of your home that you used for business. You may use the number of square feet in your home or any other method that accurately reflects the business use percentage of your home. And we can see here that it shows on line 1 the area that is exclusively used for business purposes, and then the area of the home in total. And you're going to take line 1 and divide that by line 2. And then it has a little blurb here about for daycare facilities not exclusively used for business, go to line 4. So remember I told you there was an exception for daycare businesses and that you don't have to prove that your daycare business was exclusively used for business? The Amway that you hold in your kitchen or in your living room would not qualify. But if you did an activity in your home for your business and your business is child daycare, then you don't have to show that each room in your house was specifically 100% devoted to child daycare. You'd still be allowed to deduct it. And here's an illustration of how that would work. Figuring the business use percentage for a child daycare, we have Mary Contrary, who used her 1,600 square foot finished basement to operate a daycare business for children. The house that she lives in is 3,200 square feet in size, and that does include the basement. She used the basement for daycare an average of 12 hours a day, 5 days a week, for 50 weeks during the year. And during the other 12 hours a day, the family could use the basement. So we have, firstly, 2 steps to figuring out the business use percentage. We enter on line 1 the business square footage of the home, and that's the basement, 1,600 square feet. And then on line 2, we enter the total area of the home, 3,200 square feet. When we divide 16 by 32, we get 50%. Then we have to go over and start doing some math here, and this is where I do the figure counting or I get out the calculator. I'm saying, okay, it was 12 hours a day times 5 days a week times 50 weeks in a year. How many hours is it that children were in that home? And the answer is they were in the home 3,000 hours during the year. And the IRS says that there's a total of 8,784 hours in a year. So we're going to take 3,000 hours that the children were in the home and divide that by the total number of hours during the year. And when we do that, we get 34.15%. The next step is to take 34.15 and multiply that by 50%. And when we do that, we get 17.08%. That is going to be the percentage of the home that Mary Contrary is allowed to claim as a business expense. How do you figure your allowable deduction by completing Form 8829? Well, one of the things you have to notice when we look at 8829 is that there are 2 columns. Column A is the direct expense column, and column B is the indirect expense column. And if you are operating a loss on your Schedule C, your ability to claim expenses on 8829 is going to be limited. But if you're running a profit on Schedule C, they can kick in and help you quite a bit. And what I've done here is I've outlined or drawn a pink line around line 9. You can see we've got line 9 is casualty losses, line 10 is deductible mortgage interest, and line 11 is real estate taxes. All of these 3 items have something in common. And what they have in common is that you can claim those expenses on Schedule A as an itemized deduction. And so IRS is saying that if you have any of these expenses, go ahead and enter them on the 8829, and presumably they would be entered in the indirect column because they're probably for the house as a whole and not specific to the daycare. And whatever number you get on the indirect expense line, you're going to multiply by the business use percentage that you figured up above for Mary Contrary. We then move down to the next part of the 8829, and it's all part of the same part, frankly. I just pull it out as being separate. There's kind of this gray bar dividing the 2 sections, and above it we have 9, 10, and 11. Those are the deductions that can go on Schedule A. And then underneath that we have all of the deductions that are not deductible on Schedule A. Things like excess mortgage interest, insurance, rent, repairs and maintenance, utilities, and other expenses of maintaining and keeping up the home. None of those are deductible on Schedule A. And so on 8829, they're separated out. But if you have an expense that's direct to the business, you entered in the direct column. And if you have it indirect, in other words, it's relevant to the home as a whole and not specific to the business, then it would go in the indirect column. Excess mortgage interest. If the amount of home mortgage interest or qualified mortgage insurance premiums that you deduct on Schedule A is limited, enter the part of the excess that qualifies as a direct or indirect expense. So on Schedule A, you're allowed to deduct mortgage interest for loans that you have of $1 million or less. If you happen to have a home where the loan on it is more than $1 million, your interest would be limited. And so you would enter the first $1 million of indebtedness, the interest that you paid on that would go in those first lines of 8829. And then any excess interest above and beyond $1 million of indebtedness would go on line 16. Mortgage insurance is another one. It has a much lower phase out between $100,000 and $110,000 of income when you phase out on the mortgage insurance deduction. And so if you paid mortgage insurance but your income is above $110,000, you wouldn't be allowed to deduct it on Schedule A, and therefore you wouldn't enter it on those earlier lines of the 8829. Instead, you would enter that amount on line 16. Line 17 is for insurance, line 18 rent, line 19 repairs and maintenance, line 20 utilities. Enter amounts paid for electricity, water, sewer, gas, heating oil, garbage, security services, etc. And then line 21, any other expense you can think of that doesn't have a line, you enter it there. Now there is also a line where you enter carryover amounts from an earlier year. And I'm going to show you in a minute how those carryover amounts come into play. But essentially, the purpose of breaking the form up into two parts, and I call it two parts without there being two parts in here. We've got the 9, 10, 11, where we have casualty loss, deductible mortgage, and real estate tax. And then separate from that, we have all of the other expenses that can be claimed. And the reason that the IRS breaks those out is even if your Schedule C is running a loss, you're still going to be allowed a deduction for the indirect expenses that appear on lines 9, 10, and 11. But if your Schedule C is running at a loss and you have expenses on any of these other lines that are outlined in pink, then you're going to have a carry forward. You're not going to be allowed to claim that deduction. It will carry forward. And if you have a carry forward from 2011 into 2012, then you would enter that on line 24. And then in part 3 of the form, this is where we figure depreciation on your home. And you would need to complete 4562 for the first year you begin depreciation on your home. And then there's room on the form for entering the smaller of your home's adjusted basis or the fair market value. Subtract out the land value to get the basis in the building, and then figure the amount of depreciation that you are allowed to claim on the building. Part 4 is where we have the carryover of unallowed expenses to 2013. So if it is established that you're not allowed to deduct all of your 2012 expenses because home office is throwing your Schedule C into a loss, and you're not allowed to have a loss due to home office expenses, you're going to have a carry forward. And you figure that carry forward amount and enter it on lines 42 and 43. So let's look at an illustration here of a business that's going to fill out 8829 and how all the numbers come together. The following form 8829 is assuming the following information. Number 1, that Schedule C is showing a profit on line 29 of the Schedule C totaling $5,000. Home office expenses for this business are as follows. Mortgage interest $10,000, real estate tax $1,000, insurance $500, repairs and maintenance $2,000, and utilities $1,000. The home is 2,000 square feet, the office is 200 square feet, and there is a carryover of home office expenses from 2011 in the amount of $300. Basis of the home and the land is $150, with the land portion of that value being $50,000. So let's take a look at how we start this form off. Firstly, on line 1, we enter the square footage of the office. It's exclusive business use. That's $200. Then we enter the entire area of the home at 2,000 square feet, and we get 10% business use. Moving on line 8, we enter the profit from the business, the profit from the Schedule C, and that's $5,000. Then on line 10, we enter the deductible mortgage interest, and on line 11, we enter the real estate taxes. We add those up, and we get $11,000. Now we need to multiply $11,000 by the business use percentage, and when we do that, 10%, we get $1,100. We take $1,100 and subtract that from the profit, $5,000, and we get $3,900. Next, we go over into this little peach-colored section here, and we enter $500, $2,000, and $1,000, representing the insurance, repairs, and utility expenses. When we add that up, we get $3,500, and now we're going to multiply $3,500 by the business use percentage. When we do that, we get $350. Then we enter the carryover from the earlier year, 2011, $300, and we add those two numbers up, and we have $650. We're going to be allowed the $650 as an expense deduction because it is less than the profit. See, the profit is $3,900 after we deduct those other expenses. So $650 can come out, and when we do that, $3,250. Now we go over and figure depreciation, and in this case, for this house, depreciation came out at $256. That also is allowed as a deduction. We enter the $256. We subtract that out of $3,250, and when we do that, we get $2,006, and you carry that down to the Schedule C. But let's look at the next illustration, because we have a $5,000 loss in the next illustration. I was trying to show you how the difference between the 8829s work. And on the first 8829, we start with a $5,000 profit. And on the second 8829, we have a $5,000 loss. And I just have those differences there to show you how 8829 will allow certain expenses to be claimed when you have a profit, but it will disallow and force a carry forward of other expenses when you're running a loss. So we do the top section of the form exactly the same in both of them to figure the business use percentage at 10%. Then on line 8, we have $5,000 as a loss, a negative number. And we use lines 9 and 10 and 12 and 13 to figure that our expense deduction for home mortgage interest and real estate taxes is $1,100. We take the $1,100, and that will be allowed as a deduction. And it's going to be allowed to increase that loss from $5,000 up to $6,100. So when we go over to the Schedule C, we end up with $6,100 loss that is allowed. The remaining numbers that we see on here, the $350 for the utilities and the insurance, that $350 is not allowed, and the $300 that appears under that also is not allowed. And those amounts total $650, and then we have the depreciation that is also not allowed at $256. And so those numbers, the $650 and the $256, do carry down to Part 4, and you can see on line 42 and 43, they are being forced over to a carryover. And when we go back up to the earlier form, you can see that lines 42 and 43 are blank because we are not forced to do a carry forward. $5,000 of income from the Schedule C. Then we have $1,100 of expense that is allowed for the mortgage interest and real estate tax. We have $350 that's allowed for the utilities and the insurance. We have $300 that is a carry forward, and we have $256 that is for depreciation. When we add all of those expenses up, we get $2,006. And the $2,006, that's the allowable deduction for home office expense. So we've got line 30, we're going to carry down that $2,006 total combined expense for the home office, and it includes the carry forward, it includes the depreciation, and there is no forced carry forward to the next year because we have a profit. The profit is $5,000. We subtract that expense out, and we get $2,994 as the net profit from the business. And then we move over to the next line, or the next form or illustration. In this case, the total home office expense we're allowed is only the portion of the home office expense that has to do with the mortgage interest and real estate taxes that would have been allowed in full on Schedule A anyway, presumably. And when we add those up, we get $1,100, and that is the home office expense deduction that can be entered on Schedule C. And of course, it is allowed to increase the loss on the Schedule C from a loss of $5,000 to a loss of $6,100. So you can't say that home office is never allowed to put you into a loss or is never allowed to increase a loss on a business. What you can say is that any expenses claimed on 8829 can only contribute to increased loss to the extent that they are attributable to interest and taxes, and that any of these other types of expenses are going to force you into a carry forward if you are in a loss situation. Now, beginning in 2013, we're talking about 2012 laws. I'm teaching this class, but we're in 2013 looking forward to the 2014 season. Well, I don't know that I'm looking forward to it yet. I think we're all quite happy that tax season is behind us and we're ready to enjoy a lovely summer, relaxing fall, Christmas season before we get into 2014 tax season. But when we do get to 2014 in the new year, there's going to be a new method in play on how we can claim our deduction for home office expenses. You can use the old method that I just finished showing you, but the new method is going to be simpler. Beginning in tax year 2013, taxpayers may use a simplified option when figuring the deduction for business use of home. This simplified option does not change the criteria for who may claim a home office deduction. It merely simplifies the calculation. So you're still going to have to show that it's exclusive use. You're still going to have to show that you have the office area in your home set out, and you're still going to have to meet all of those other business purposes. But once you've done that, instead of figuring the percentage of each of the expenses for your home and doing a factor and calculating that over, and then remembering to reduce how much you claim on Schedule A because you claimed it on 8829, the IRS says just claim $5 per square foot instead. So the highlights of the simplified option are that you'll be able to claim a standard deduction for 8829 of $5 per square foot of the home used for business, but the maximum allowance will be 300 square feet. The allowable home-related itemized deductions are still going to be claimed in full on Schedule A. So, for example, you won't have to reduce the amount you put on Schedule A for real estate taxes and mortgage interest. You'll claim them in full, and then you'll just claim $5 per square foot. Well, in this situation, if you had a 100 square foot office, like I had up here earlier, we came out in that scenario with mortgage interest and real estate taxes of $1,100. We had $650 of carry forward plus $350 of utilities and so forth, and then we had a $256 amount for depreciation. Well, all of those numbers added up to $2,006. That's more than $500 that we would get under the simplified method that the IRS is now offering. But of course, of the $2,006 that's being deducted, we're having to reduce the itemized deductions by $1,100. So under this new method, IRS would say instead of reducing your itemized deductions by $1,100, just claim a deduction for $500 and you're done. So if you think that that works for your client and that's what you'd like to do, then you can do that, beginning with 2013 returns. And this little chart here provides a summary of the comparison between the two different methods. I'll leave you to read that on your own. The next item in line is the domestic activities production deduction. That one has a nice ring to it, I think. It makes me think of conjunction, junction, what's your function. Back to the cartoon days, the Saturday morning cartoons back in the 70s, they had these little songs that played, and one of them was conjunction, junction, what's your function? And whenever I see the domestic activities production deduction, I think of that little jingle. At any rate, this particular deduction is not claimed on Schedule C. It's claimed on 1040. And you're allowed to claim the deduction if you can show that your Schedule C activity had to do with production of an item. Or basically, you manufacture something for sale. And if you can show that you're manufacturing and that you have a profit, you might be able to claim an extra deduction. For 2012, the deduction is 9% of your qualified production activity income from the following activities. Construction of real property performed in the United States. So the question I was getting earlier was, my client builds houses. Well, your client may not be able to report that building or construction cost on Schedule D, because I wouldn't call that a capital asset at all. That's definitely a business. But he is manufacturing or doing the construction of real property inside the United States, so he could be eligible for this 9% qualified production activities deduction. Also, engineering or architectural services performed inside of the United States. Any lease, rental, sale, exchange, or other disposition of tangible personal property, computer software, and sound recordings that the taxpayer manufactured, produced, grew, or extracted in whole or in significant part within the United States. Any qualified film produced by the taxpayer. Electricity, natural gas, or potable water produced by the taxpayer. In certain cases, the reference to the United States also includes Puerto Rico. Your deduction may be reduced if you had oil-related qualified production activities income. The deduction does not apply, however, to income that comes from the sale of food and beverages prepared at a retail establishment such as a bar or a restaurant, property leased, licensed, or rented for use by a related person, the transmission, distribution of electricity, natural gas, or potable water, or the lease, rental, license, sale, exchange, or other disposition of land. Requirements for deduction. To qualify to claim the deduction, your business must have net income or profit from a qualified production activity. In other words, you have to be manufacturing something that you are then selling, and you have to have a profit from that activity. You must also have, if you're a sole proprietor, positive adjusted gross income on your tax return. So when you're looking at the front page of 1040, you're looking at all of the income items you have, and you get to that bottom line where your adjusted gross income is showing. It has to be a positive number. If it's a negative number, you're not allowed to claim the deduction. And then we have the business must have paid wages to employees that are allocable to the domestic production activity. So this final rule here, point number 3, is the reason why there's not a lot of sole proprietors who qualify for this deduction. It may not be hard to show that you manufacture a product for sale in the United States, and it may not be hard to show that you have positive adjusted gross income. But a lot of sole proprietors don't keep employees. They don't have employees. They do all of the work themselves without employees, and as such, they fail to meet the final criteria here for claiming the domestic production activities deduction. But if your business did have employees, you have positive AGI on your tax return, and you have net profit from your business activity that is the domestic production activity, you can claim the deduction. Now, you may qualify for the deduction as a self-employed person, but you could also qualify to claim the deduction if you have an interest in a state, trust, partnership, or S corporation that qualifies for the deduction. And in this case, if you're qualifying for the deduction, it would flow through to you on a Schedule K-1 that you would receive from one of those entities. Now, the activity must be a trade or business. Qualified production activity income and Form W-2 wages are figured by only taking into account items that are attributable to the actual conduct of a trade or business. An activity qualifies as a trade or business if your primary purpose for engaging in the activity is for income or profit, and you are involved in the activity with continuity and regularity. For example, a sporadic activity or a hobby does not qualify as a trade or business. And here we have a chart. I happened to just find this yesterday, and I went, that's kind of cool, because for several years that I've been teaching this class, I've been making the comment that, you know, if you claim the qualified domestic production activities deduction on your federal return, it's possible that you're going to have an addition on the state return. And the reason I've said that is in the state of Oregon where I live, it is an addition. And in the state of California right next door, it is also an addition. So I quite logically concluded if two states have it, odds are lots of states have it. And yesterday I found this table that actually shows which states allow the deduction and which do not. And all of the states that are in dark blue here allow the domestic production activities deduction to flow through from the federal return and be allowed at the state level. And all of the states that are in this gray color disallow the deduction. So if you're preparing a tax return for a client who lives in any of the states shown in gray, then you're going to have an adjustment that needs to be made on the state return, probably to add that deduction back into income. And then we have a few white states, South Dakota, Washington, Nevada, that are not affected by the deduction at all. And those are states that don't have business tax returns that get filed. They don't have income taxes in those states. Form 8903, the deduction, when you want to claim the domestic production activities deduction, you do so on Form 8903. You use the form to figure the amount of the deduction and to report to the IRS that you are in fact claiming it. To calculate the deduction, it is necessary for a business to separate gross receipts and production costs from the qualifying domestically produced activity income from other non-qualifying income and expenses of the business. There is a safe harbor rule that allows taxpayers to treat all gross receipts as domestic production gross receipts if non-DPGR income is less than 5% of the total gross receipts. Your domestic production activities deduction is the lesser of your domestic activity production income multiplied by 9%, or 50% of the W-2 wages paid. So let's see what that means. In order to claim the deduction, you have to show that you're in business producing or manufacturing an item inside of the United States. And you have to show that you did so at a profit, and you have to show that you paid W-2 wages associated with that activity. It's also the situation that your business could really have two types of business going on, and I'll give you an example. We had a client for a period of time that had two sides to his business. One side of the business was construction. He built decks and fences, and that is a production activity that would qualify for the deduction. He's producing or manufacturing an item for delivery to customers inside of the United States, improvements to real property and so forth. So it was definitely allowed under the rules. But separate and aside from that, he also had a retail business where he sold home improvement items. And the retail side of it and the decking side of it were both part of the same company. The same company was engaging in both those activities. And so when it came to figuring the domestic production activities deduction, it was necessary to break those two activities apart and show the domestic production activities deduction was only based upon gross receipts due to the decking business and not any part of it being associated with the retail business. Also, you can claim the domestic production activities deduction in relation to oil-related production activities income, but if you do so, the deduction is reduced by 3%. So the maximum would not be 9, it would be 6. Coordination with other deductions. Your deduction may be limited by basis limits on a partner share of partnership losses, basis limits on a shareholder share of S corporation losses, the at-risk rules, the passive activity loss rules, and any other provision of the Internal Revenue Code. So there's more to it than I'm about to explain to you, but if you know what you're doing, it's a fairly simple calculation to do. In our illustration, we have a character named Jacob. He owns a furniture manufacturing business with the following income and expenses for the year. Gross receipts are $100,000. The cost of materials is $30,000. His wages were $25,000, and he had a net profit of $45,000. Things are already looking up for Jacob. It appears quite sincerely that he's going to meet all of the requirements for claiming this particular deduction. He also received a 1099 DIV during the year showing non-qualified dividend income of $10,000 for the year. Figure is 8903 as shown next. We're going to begin on line 1 of the form for all activities. You can see column A is for oil production activities. He's going to move over to column B, and he's going to enter $100,000 as the activity income. He adds up all of his expenses here. You can see we've got $30,000 and $25,000. That's $55,000 of expenses, and those expenses are directly allocable to the domestic production activity. He'll enter those on line 3. We then do some math, a simple computation, and we get $45,000. And now we're ready for the second part of the step, which is to look to see what his adjusted gross income was. And his AGI is going to be higher than his total profit from the business because he had that dividend income, $10,000 of dividend income. So you take his income from his business, you add in the dividend income, you subtract out 50% of the self-employment tax, and when you're left and done, you have $51,821. That's definitely positive adjusted gross income, but we're not done. We also have to then do a multiplication of the net profit on the business, and that's going to be multiply $45,000 by 9%, and when we do that, we get $4,050. Next step is to take the wages that were paid. Multiply the $25,000 of wage income. Take that $25,000 of wage income and enter that on line 16, and then we multiply that by 50%, and when we do that, we get $12,500. The deduction that Jacob is allowed to claim is the lesser of 50% of the W-2 wages or the domestic production activity income multiplied by 9%. In this case, that is $4,050. That carries down and is entered on line 35. Voyager, V-O-Y-A-G-E-R, Voyager. And we're on to the next topic now, which is business credits. And business credits are a whole topic in and of themselves. I actually teach a whole class on nothing but business credits. And that's coming up in the end of August, third week of August, approximately in there. We're going to talk about federal tax credits for business. I'm not doing that today. It's a fairly complex calculation, and when I do teach that class, we're going to get into Form 3800, how to complete it. We'll do scenarios where we've got businesses that are claiming tax credits for employee tax on tips and for the health insurance credit and a variety of other credits like the disabled access credit. But for today, I'm merely going to tell you that if you are in business, it's possible you could qualify for a business credit. And some of the business credits you could qualify for are the investment credit, the American Samoa Economic Development Credit, the Work Opportunity Credit, the New Hire Retention Credit. That's actually history. It's gone. That was just a one-year temporary credit. The credit for alcohol used as a fuel. Form 6765, credit for increasing research activities. We also have the low-income housing credit, the recapture of low-income housing credit, the orphan drug credit, the disabled access credit, the qualified electric vehicle credit, the renewable electricity production credit, the empowerment zone employment credit, the Indian employment credit, the credit for employer Social Security and Medicare taxes paid on certain employee tips, biodiesel and renewable diesel fuel credits, the new markets credit, the credit for employer pension plan startup costs, the credit for employer-provided child care facilities and services, the low-sulfur diesel fuel production credit, the qualified railroad track maintenance credit, the distilled spirits credit, the non-conventional source fuel credit, the energy-efficient home credit. There's two different methods of that one. Then we've got the alternative motor vehicle credit, the alternative vehicle refueling property credit, the mine rescue team training credit, the agricultural chemicals security credit, the carbon dioxide sequestration credit, the qualified plug-in electric drive motor credit, and finally, the credit for small employer health insurance premiums. Some of these credits have been around for a long time. Some are just temporary. Some have carry forwards that are still being used today, but the credit itself hasn't been around in a while. We get into some of the more common of these credits in the class that I teach in August. At any rate, if you qualify for any of those credits, you need to complete the form associated with the credit, and then you also need to complete 3800, the General Business Credit Form, and then claim it. Employer reporting requirements is the next topic that we're on to today. And if you are in business and you have employees, you've entered a whole new realm of how can I get in trouble in the fastest way possible. As a business owner, the types of things I see people do to get themselves into trouble with employees is always amazing. And part of it's because the business owner just doesn't really understand the importance or the level of care that needs to be taken when it comes to payroll. Essentially, laws have been created. Has nothing to do with what we think of them as tax practitioners, but laws have been created many, many years ago, and the IRS enforces those laws. And one of the laws is a definition of what is an employee. And if you've got a small business owner who has a worker performing services for them, and that worker meets the requirements for being an employee, that employer is required to treat that person as an employee. They have legal obligations in terms of doing Social Security and Medicare tax withholding, doing income tax withholding, issuing a W-2, and in turn sending all of that money over to the Internal Revenue Service. And the IRS looks at employer requirements on those payroll taxes in a much different way than it looks on income tax. It looks at it more strictly with greater emphasis and greater penalty. And so in this most recent economic recession that we've been scraping our way out of, I saw a lot of businesses that had been doing quite well for quite a long time all of a sudden having huge, huge problems. And one business that's in the back of my mind was a shoe business. They imported shoes. They designed shoes, had them manufactured, and then imported from China. And they were selling them and doing quite well with that business until the recession hit. And then their lines of credit were pulled by banks. China went from a COD policy to a pay-us-up-front policy, and they had no cash flow. And so the business owner started looking for places that she could find cash, and the place that she went was the employee withholdings. So she was paying her employees their payroll, and then when it was coming time to take those payroll taxes and send them to the government, she didn't do it. She was holding on to that money and using it to help her business survive. And she thought that that was okay. But if you know anything about what the IRS has to say about that, it is not okay. And the IRS looks at an employer relationship with an employee with respect to that money that the employer holds out from that employee as a trust situation or as a trustee situation. So the employer is holding tax out of that employee's wage in trust to turn over to the government. And when the employer doesn't turn it over to the government says that the employer has stolen the money from the company or from the government, or even from the employee. Any way you cut it, it's stolen, stolen, stolen. And so the IRS looks on that much more aggressively. And I've been in a couple of audits where the payroll taxes were not being paid out the way they should have been, and who shows up is not just an IRS auditor, but really a revenue agent who has a gun and a badge. So the emphasis on those things is crucial, and I think it's important that we understand how important it is to help our clients stay in compliance with those laws. So that's a little bit about what's going on here with employer reporting requirements. Whenever you have a business owner that is employing staff, employing people to work for him or her, then there is going to be an employer-employee relationship, and there's going to be a trustee relationship going on there as well with regards to the payroll taxes. So when you are self-employed, there's a number of different forms that you need to file. And of course, the first one is what we've been talking about most of today's class, which is the Schedule C. And if you turn in that profit off your business, there would be a Schedule SE. And then if you are making a profit, you should be paying those estimated taxes throughout the year. And then if you have employees, you move on to the 941 requirement. And the 941 is filed 4 times a year, due at the end of each quarter. And the 941 is used to show the amount of payroll paid to employees during the year and the amount of withholding that you've done off those employee wages, and also to show a matching contribution for the employer share of Social Security and Medicare tax. Then there's also the FUTA tax return. The FUTA return is a 940 return that's filed once each year. It's due in January. And then there are the various information returns that a small business may need to file, and in certain situations there could be excise returns as well. So let's talk a little bit about those 941 and 940 returns. If you are an employer, you are required to do withholding on your employee's pay of 6.2% for each dollar paid to the employee. And then you match with another 6.2% that comes from the income of the business itself. So there's a total of 12.4% Social Security tax that needs to be paid on every dollar of wage paid to an employee. And by that same token, there's also another 2.9% Medicare tax that's paid on each dollar of wage paid to the employee for Medicare tax. And the way it works with the 941 is that the employer withholds 6.2% Social Security and 1.45% Medicare, and then matches those two amounts and sends the money off to the government. And then once each year in January, there's an additional tax owed called the FUTA tax, which is the federal unemployment tax. So those forms need to be filed by any business that has employees, and there is a legal requirement there. Now, when you are hiring workers to come work for you in your business and you want to verify the accuracy of the Social Security numbers that they have given you, you can use the Social Security Number Verification Service. If you want to know more about that service and how it works, there is a link here inside the manual. And of course, it is very important to get the Social Security numbers correct on W-2s, because if you get them wrong, you're probably going to get letters from the IRS, and you also cause misery for other people whose numbers have been used. Now, clearly, when we work in a world where there are undocumented workers who cannot get Social Security numbers, so they make up fake cards and give them to employers, there's going to be a lot of problems occurring out there in general with workers who are giving employers fake ID. And the Social Security number verification system is a way that an employer can verify that a number they've been given is accurate. For small employers, there's no requirement that they use the system, but the system is available and should be used just to verify that a person can work. And then I see a comment here. What about a person switching from a DBA to an LLC or S Corp? What do you do for owner's income? Trying to understand what your question is here. If you have a person who is a sole proprietor and they've been filing a Schedule C and they decide to form an LLC, well, nothing would change because the LLC is a disregarded entity. It would file the same Schedule C that it always has. But if you decide to form an S corporation and you get that S election accepted by the IRS, then any work you perform for your corporation would be the work done as if you were an employee of the corporation. The corporation would now treat you as an employee and give you a W-2. And then the corporation would need to do 940s and 941s that reflected payments made to you. The next item that you deal with when you are self-employed is, of course, the self-employment tax. And self-employment tax is the equivalent of the employer payroll tax that is reported on that 941 form. And essentially, for 2012, there was a 2-point reduction in the amount of withholding for Social Security purposes for the employee share. So normally the employer share is 6.2% and the employee share is also 6.2%. But for 2011 and 12 only, it's been reduced on the employee share part to 4.2%. And because the employee share of Social Security tax went down by 2%, the self-employment tax also went down by 2%, and the 2% that went down was the employee share of that particular tax. You figure the self-employment tax on Schedule SE, and one of the main things I point out about self-employment tax is that self-employment tax is a really big tax for most small business owners. If you've got a small business owner who's managing to scrape out a profit each year for themselves of, say, $50,000, odds are their income tax on that $50,000 is going to be not a whole lot of money. They probably got a couple kids, maybe a spouse, maybe a mortgage. So when they're all said and done, there's not going to be a whole lot of income tax they owe on that $50,000. But there's going to be a ton of Social Security and Medicare tax equivalent, but self-employment tax that's going to be owed on that money. So for most small business owners, I would say the self-employment tax is the biggest tax that they ever have to deal with. Now, of the self-employment tax, there's two components. There's the Medicare tax component and the Social Security component. And the Social Security component is only due on the first $110,100 of wage and self-employment income for the year. So if you have a client who is self-employed, but they also have a W-2, and the W-2 shows they earned $80,000, and their business generated another $80,000, well, they're not going to owe self-employment tax on the full additional $80,000 because they only owe the Social Security portion of the self-employment tax on income of up to $110,100, you'd subtract out the $80 from the W-2, and you'd be left with only $31,100 that would be exposed to the full amount of self-employment tax. But no matter what, you never max out on Medicare tax, and you owe that in full on the full profits of the company. Now, there is an optional method for calculating self-employment tax. Believe it or not, you might have a person who doesn't owe self-employment tax because their business didn't turn a big enough profit to have a calculation going on for self-employment tax, but they might want to volunteer and pay it anyway. And why would they want to do that? Well, there's a number of reasons why you might voluntarily increase your income for purposes of self-employment tax. One of them is because you want to increase the amount of money you're paying into that Social Security pool so that when you do retire on Social Security, you get more. Another is that by increasing the amount of self-employment tax you have, you might increase the amount of earned income credit you're entitled to. And you might also increase the amount of additional child tax credit you're entitled to, or the child independent care credit could go up. And it might allow you to claim a larger self-employed health insurance deduction. So there are some reasons there why you might decide to pay self-employment tax even though you're not required to. And if you wish to do it, you use the optional method for calculating the self-employment tax. There's the farm optional method and the non-farm optional method. Under the farm method, if you want to use this method to figure your self-employment tax, you have to show that your gross farm income was $6,780 or less, or that your net farm profit was $4,894 or less. If you can show that it was, then you might be able to come in and use the non-farm method. Net farm profits are the total amount that comes from Schedule F and from Schedule K1 Box 14 Code A from farm partnerships. There's no limit on how many years you can use the farm optional method. How do you use the farm optional method? Well, to use the farm optional method, you have to complete Schedule SE, page 2, and in Part 2, line 15, you would report 2/3 of your gross farm income up to $4,520 as your net earnings. So you might have a situation where the farm ran a loss, but you can show that the gross receipts were $5,000 for the year. And if that's the case, then you would enter the gross receipts for the farm up to $4,520, and you would pay the self-employment tax based on those calculations. The farm optional method can increase or decrease your net earnings from farm self-employment, even if the farming business had a loss. Now, the non-farm optional method, you may be able to use this method to figure your net earnings from non-farm self-employment if your net non-farm profits were less than $4,894 and also less than 72.189% of your gross non-farm income. Net non-farm profits are the total of the amounts from Schedule C and also from Schedule K1 that is reporting flow-through income from a partnership. To use the non-farm method, you must be regularly self-employed, and you are regularly self-employed if your actual net earnings from self-employment were $400 or more in 2 of the last 3 preceding years. The net earnings have to be $400 or more and could be from either farm or non-farm earnings or both. Use the non-farm optional method from non-farm self-employment, or use of the non-farm optional method to figure self-employment tax under the non-farm method is limited to 5 years, but the years do not have to be consecutive. So 5 times in your lifetime, essentially, you were allowed to use the non-farm method to pay into the Social Security system more tax than would otherwise be assessed upon you. If you want to use the non-farm method, you have to figure the amount of self-employment tax on page 2 of Schedule SE. And I have Schedule SE up on the screen in front of you. Page 1 of the form includes a flow chart, and the purpose of the flow chart is to establish whether or not you can figure self-employment tax in Part 1 of the form, or whether you need to do the longhand and fill out Part 2. But you would never do both. You either do side 1 of Schedule SE or you do the side 2 of Schedule SE. You never do both. And this flow chart on the front basically walks you through and helps you decide which side you're going to fill out. Side 1 is what I'm going to look at first, and it's pretty self-explanatory. You take the net profit from your business and enter it on line 1A. And then a net profit from farming on line 1A and net profit from any other business activity on line 2. And then on line 4, you're going to multiply the total of your farm and non-farm income by 92.35%. And you enter that total on line 4. And then after you've got a total on line 4, you ask yourself, is the amount of income I have from wages and self-employment $110,100 or more? And if it is, then you're going to do a couple of calculations. But if it's not more, then you essentially take the 13.3% for 2012 and multiply it by the amount shown on line 4. But if the income is in excess of 110,100, you might only need to multiply it by 2.9% because that's the Medicare portion only. Whenever you finally figure the amount of self-employment tax you owe, you enter that total on line 5, you carry it over to page 2 of Form 1040 and enter it as self-employment tax on page 2. And then on line 6, you multiply the amount on line 5 by 57.51%. Now, for most of the history of the self-employment tax, the deduction for self-employment tax has been 50% of the self-employment tax. But for 2011 and 12 only, the self-employment tax employer portion is more than 50% of the self-employment tax. It's 57.51%. But for 2013 and future years, we will be back down to seeing 50% of line 5. For page 2, the main reason you would move over to page 2 is because you want to either use one of the optional methods to figure your self-employment tax, or because you have self-employment income being reported for a minister or a member of the clergy. And if either of those applies, you would fill out Part 2. And when we get over to Part 2, you can see it's a longhand method. And one of the things it says is on line A, if you are a minister, member of a religious order, or a Christian Science practitioner, and you filed Form 4361, but you had $400 or more of net earnings from other self-employment, check here. Well, most ministers have not filed that particular form. That form is used to say, hey, I have a religious objection to the Social Security system. I'm not going to pay into it, and when I retire, I will get nothing from it. Most ministers, when they find out that's what happens, don't go for it. So instead, if you are a minister, you would enter your income from housing allowance and from other ministerial work as income on Schedule SE on page 2, and you'd figure your self-employment tax on that. When we get down to the bottom, you can see this is where we have the optional methods in play. And then we'll move on to local taxes. Local taxes, this is a federal course, but I think you can't teach federal law without at least mentioning what happens at the state level. Most businesses are paying taxes at the state level. It might be that they're paying an income tax, but it's more likely that they're doing sales tax collection whenever they make a sale. Some states, like Washington State, have a B&O tax, which is a business and occupation tax, and off the gross receipts, that business is supposed to be making payments to Washington State for the B&O tax. So I can't know what state that you're in as a participant in this course. I don't know what the state laws are for the state that you're in. I can just tell you that there are state laws in existence, and you should make it your business to know exactly what those are. If you're working on a tax return for a self-employed person, your responsibility extends, I believe, beyond the Schedule C and also into the other parameters that they have at the state level. So if they have filing requirements at the state level, you should familiarize yourself with what those are so that you can help them fulfill those. So essentially, the most common types of taxes I see at the local level are income taxes on business profits, sale and revenue taxes on gross sales, and also personal property taxes are assessed on assets of the business that are operating within boundaries. And I believe that virtually every state in the country does assess some form of personal property tax on business property. And so if you're looking at the business property of a tax service, you're going to have computers and office equipment and furniture. And each year, for completion of the personal property tax report, you're going to have to make a list of all the assets that you have in your business and what those assets are worth. And then the tax assessor's office figures out what the personal property tax is on that list that you give them, and they send you a bill. So that's another one that's due. The next topic we're looking at is profit or loss from farming. And today's class is definitely not about farming, and I'm not really a specialist in farming either. I'm a city girl, and we just don't get a lot of farmers coming into our offices. But I've done a few farm returns over the years, and for the most part, they look fairly much like filling out a Schedule C, except they've got some odd descriptions. You know, Schedule C doesn't provide lines to enter crop income and this income and that income. It's limited to just a few different types of income. But with farm returns, you're breaking it down into a much greater number of types of income and the different types of farming activities that generate that income. But on top of that, there are some rules about farming that are unique to farming, and I'm going to touch on a few of the things that make a farm return different. And if I haven't told you where it's different, then it's probably the same. So you can see here we've got car and truck on the Schedule F. Then there's a line for chemicals, custom hire. But depreciation, if you enter depreciation on a farm return, you're going to have to probably figure out a 4562. There's going to be some different rules applying to depreciation for farmers than from other activities, but you still have to do a 4562. And then we move over to page 2 of the farm return. We've got accrual method of farming and some different agricultural activity codes for the type of business activity the farming is engaged in. So a key thing to remember about farming is that the forms and attachments used with the Schedule F are very often the same as what you would use for Schedule C. For example, whether you're reporting business expenses and income on Schedule C, Schedule F, Form 1120 for a corporation, Form 1120S for an S corporation, or Form 1065 for a partnership, assets are always depreciated on that same 4562. The rules you apply when you fill the form out may vary somewhat, but it's still the same form. Having said that, it is also important to make note of special tax laws that are unique to farming and do not apply to other types of business income. For example, farmers are not allowed to use the 200% declining balance. So when you're doing maker's depreciation, if you have not told the computer that this is a farmer, it might do depreciation incorrectly. Farmers are allowed to claim 150% declining balance only. And with a farm, the asset that's being depreciated might not be a desk. Instead, it might be a pig. If it's a breeding pig or if it's a milk cow, and the farmer goes out and buys a milk cow for use in producing milk as a part of his business, then that milk cow becomes a depreciable asset. And then there's also the question of, is the asset that I'm looking at an asset or is it inventory? So you have to look to the nature of how that particular item or creature is being utilized. If we have a milk cow that is being used to produce milk, then we would say that that milk cow is an asset used for income production. And if that milk cow was purchased, then that milk cow actually is depreciable. On the other hand, if you purchased feeder cattle, young bullocks or whatever, to raise and then sell for slaughter, that would be a form of inventory. And so you'd have to account for those things differently. The IRS has published 10 key issues that it identifies as having problems, or that, in other words, people who file farm returns have 10 particular points where there's usually a problem, and these are summarized here. Firstly, crop insurance proceeds. You must include in income any crop insurance proceeds you receive as a result of crop damage, and you generally include them in the year you receive them. Sales caused by weather. Related condition. If you sell more livestock, including poultry, than you normally would in a year because of weather-related conditions, you may be able to postpone reporting the gain from selling the additional animals due to the weather until the next year. Farm income averaging. You may be able to average all or some of your current year's farm income by allocating it to the 3 prior years. This may result in a lower current year tax if your current year income from farming is high, and your taxable income from 1 or more of the 3 prior years was low. This method does not change your prior year tax. It uses the prior year information to determine how much tax you're going to pay in the current year. Deductible farm expenses. The ordinary and necessary costs of operating a farm for profit are deductible business expenses. An ordinary expense is an expense that is common and accepted in the farming business. A necessary expense is one that is appropriate for the business. Employees and hired help. You can deduct reasonable wages paid for labor hired to perform your farming operations, and this includes full-time and part-time workers. You must withhold Social Security and Medicare taxes and income taxes on these employees. And so apparently the IRS is saying this is a big problem, that a lot of farmers are paying cash and they're not doing the withholdings that they're supposed to. And then line 6, items purchased for resale. You may be able to deduct in the year of sale the cost of items purchased for resale, including livestock and the freight charges for transporting the livestock to the farm. If you're operating a farm, it's possible you'll have a net operating loss, and if you do, you may be able to carry that loss back to earlier years. Repayment of loans. If you repay a loan, that loan payment is not an expense, and when money is loaned to you, it is not income. However, if you can show that the loan was taken out for business purposes, then you will be able to claim the interest you pay on that loan as a business expense deduction. Fuel and road use. You may be eligible to claim a credit or refund of federal excise taxes on fuels used on a farm for farming purposes. And finally, IRS says, go to the Farmer's Tax Guide, which is IRS Publication 225, to read more about special rules that relate to farmers. And so that's the next topic I have up on the screen, which is the Farmer's Tax Guide, publication 225. And if you read through the entire publication cover to cover, it's a gripping read, of course, you'll see that there's a lot of what it talks about that is kind of similar to what we've talked about for self-employment, but also for other classes that I've taught, say, on depreciation. So I went through and I basically pulled out of the farmer's publication the key components that you should read about because they're very different for farmers, and that's the only place you might read about them. And they include agricultural program payments, which are discussed on page 10 of the publication, elected farm income on page 18, income averaging is also shown on page 18, soil and water conservation expenses on page 28, the uniform capitalization rules, those are worth a read, they're on page 31, converted wetland and highly erodible cropland on page 53, and finally, special estimated tax rules for qualifying farmers are described on page 84. Okay, so you're in business for yourself or you're a farmer and it's been a bad year. You've lost money on your business. And if you've lost money on your business, it's possible you could be thrown into a net operating loss situation. A net operating loss, the simplest way for me to say that a net operating loss for sure exists, is if you look at the front page of the tax return and there's negative adjusted gross income. If the adjusted gross income is a negative number, you have a net operating loss in most cases. So if you have a net operating loss, what does that mean? How do you deal with that? Now, it's also possible you have a net operating loss even though you have a positive AGI if certain itemized deductions allow you to go into an NOL. And of course, your income after claiming itemized deductions is line 41 of your 1040. And so IRS says you may have an NOL if line 41 is negative. But if the reason you have a negative number on line 41 is because of mortgage interest and real estate taxes, that's not going to trigger an NOL. You're going to have a negative number on line 41 because of other reasons. So, examples of typical losses that can produce an NOL include, but are not limited to, the following. You have a loss in your trade or business. You work as an employee and you have a large amount of unreimbursed employee business expenses, and you've claimed those on Schedule A. And so Schedule A is throwing you into an NOL because of these unreimbursed employee expenses. You could also be thrown into an NOL because of Schedule A because you reported a casualty or theft loss. But you can also have an NOL due to moving expenses and also to losses on rental property. A loss from operating a business is the most common reason for an NOL, and for more details about NOLs, you should refer to IRS Publication 536. It's a multi-step formula that you go through to determine what your NOL is. Firstly, you have to determine if you even have an NOL for the year, and you do a worksheet to determine that you have an NOL. And the simplest way I can say it is if you have line 22 of your tax return showing negative income, odds are that you have an NOL. Once you've established that you have an NOL, in step 3, you need to decide whether you're going to carry it back to an earlier year or waive the carryback period and carry it forward. And in most cases, a small business can carry back 2 years and then forward up to 20 years. But some situations would allow a business to go back as much as 5 years. And so here are the rules for carry back and carry forward. Eligible losses for certain small businesses can carry back 3 years. Farming losses can go back as far as 5 years. Qualified disaster losses can also go back 5 years. Qualified Gulf Opportunity Zone losses have a 5-year carryback, and the specified liability losses have a 10-year carryback. If you want to know more about any of those provisions, you're going to need to read the IRS publication on NOLs. Don't have enough time in today's class to talk about them. And I'm just going to move down to waiving the NOL carryback period. If you end up in a situation where you have a client who has an NOL, you're going to have to do some figuring. You're going to have to fill out some forms, most likely by hand, unless you've got really good software that you know how to use, to figure what the NOL is. And typically you have to figure the NOL under the regular tax, and then you have to figure it again under the alternative minimum tax. And then you need to establish whether or not you're going to do a carry back or whether you're going to do a carry forward. It's easier to do a carry forward. You just check the box that says I'm going to do a carry forward. You make the election and it carries forward to future years. If you decide you want to do a carry back, there's a couple of different ways you can do the carry back. One is a quick method using Form 1045, and the other method is to go back and do an amended return. But either way you do it, it's going to take quite a bit of work, and one of these days I'll put together a class on NOLs, but that day is not today. Thrush. 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 And then the final topic of the day, and I'm happy to see we've actually got 15 minutes so we can spend a little bit of time on this and not really just drop it, which sometimes happens. It's record keeping and financial management. Sadly, so many small business owners just are not good at this. They're so wound up in the day-to-day business of running their business, they don't stop and properly take the time to work on their books. And sometimes, even though they do stop and take time to work on their books, they're not very good at it. So what we get delivered to us is pretty bad stuff. And other times, maybe they're putting so much time into their books, so much time worrying about their books, that they're losing money that they would otherwise be making if they could just give the books to someone else and go about the business of making their business the money. So at any rate, we're going to talk a little bit about what types of advice we can give our clients with regards to managing the money and keeping records for their business. This is a conversation I have with my clients regularly and frequently. And if you aren't in the habit of doing it, then it would be helpful to your client if you could start giving them some education on record keeping and be able to explain to them in language they can understand some of the things they need to do to keep records for their business and why that's important. Now, I mentioned earlier the client who had taken money that she should have sent to the IRS for her employee taxes, and she used that to pay the operating expenses of her business. Well, I didn't know her at the time that she did that. I only met her because she had received the audit letter from the IRS on her payroll. And so she contacted my company for the first time because she was being audited. And I talked with her on the phone about what had gone on, and one of the things that I said to her over the phone was, you need to be prepared for the fact that when this auditor comes to you, they're going to tell you that you have stolen money from the government. And you need to be prepared to hear that kind of language, because when they tell you that you've stolen money from the government, that's going to be alarming to you because it is a criminal type of thing. And you need to understand why that is the case. And so I explained to her that when we got to the audit, that the IRS auditor will tell her that she has stolen. And that is exactly what happened. He told her that she was guilty of theft. And it was a real thing for a small business owner who's been struggling and doing everything she can through the hardship of a recession to find out that not only has she done everything she could, but that she should have just let the business die rather than do that. That was essentially what the auditor was telling her. So that was a huge thing for her. And then the other side of it is you have businesses that just are not good at managing their money in any respect whatsoever. What kind of advice can we give them? Tax return preparers have an ethical duty to prepare tax returns that accurately reflect the income and deduction items that are reported on the returns that they prepare. And when you are working with a tax client, the following information and advice should be communicated to your client to ensure that your client is able to support income and deduction items claimed on his or her return in the event that the return is audited by the IRS. Now, of course, most audits are not the payroll audits, but I've been in a few of those enough to see what happens. But you'll have auditors who are all over the company records. And so here are the types of things that I have had IRS auditors say to me and clients that I've been representing. You are required to keep records that prove your business income and expenses, and adequate record keeping can be accomplished in multiple ways. If you are claiming business expenses, you will need to keep the receipts clearly. And it is also wise to charge your gas and other business expenses to a different credit card than the one that you use for personal purposes. That way it is easier for both you, your accountant, and an IRS auditor to sort through and separate personal business expenses. When they're all jumbled together, it's a nightmare. You should keep an envelope in your car where you store receipts as you acquire them. So if you happen to be a contractor, and you regularly make trips to the hardware store and you're picking stuff up. You might have a business credit card that you use, but sometimes, this is just a small item. I've got $10 in my wallet. I'm going to pay cash. And now I've got this receipt because I paid cash for something. And what do I do with it? Do I stuff it in my pocket? Do I put it in the bag? And then what happens to that bag? What happens to the receipt? So the advice I give to clients is keep a manila envelope in your car so that when you do pay cash for something and you've got that receipt, you've got a place to stick it. Even if that's the only thing you do is stick it in the envelope, at least you got it, right? Then you should also maintain your business records for a minimum of 3 years from the date that you file your return. Lots of people seem to think if they keep their receipts until the end of tax season, that's good enough, and after they file the return, they can throw them out. But we all know that the IRS audit usually takes place a year after the year the return is filed, and it can take place as much as 3 years after the return has been filed. So the receipts need to be maintained at least 3 years. And finally, I have literally had IRS auditors say that a canceled check is not considered to be adequate evidence of an expense and that it needs to be accompanied by a receipt or other documentation. Not only that, I have seen IRS auditors say that the receipt by itself is not adequate evidence that an expense was paid by the taxpayer. So the taxpayer may have a receipt showing that an expense was paid, but they can't prove that they're the one that paid it. And so ideally, you would have the receipt, and you'd also have a corresponding canceled check or a corresponding credit card statement showing that this was your credit card that paid that expense, and here's the receipt proving that the expense was paid. That's the ideal world. So how much money am I really making? One of the key reasons that small businesses should do a better job of keeping their records is to figure out how much money they're making. There's a number of reasons why you need to know how much money you're making. The first one is to prepare and file tax returns. You want those to be accurate. But also, it's time to buy a house. You're up there, you're in the market, you want to purchase yourself a house. And so you're completing loan applications for banks, and you hand over a copy of the tax return to show how much money you're making. And you want that tax return to be accurate, presumably. Presumably that would be the case. Now, when it comes to borrowing money, you want your income to be higher because banks like to see people who are making money. They don't want to see people who aren't making any money. And then the other side of the situation, you've got the IRS where you'd like your profit to be as small as it can possibly be to minimize the tax that you owe. In the real world, there's one correct way to do a tax return where you maximize the amount of deductions in a legal way. If the tax return has been done correctly, it would both minimize your tax and show the correct income. And if you're applying for a loan, it ought to be based on what you're actually making, at least in theory. Also, you need to know how much you're making to plan for your retirement and to make important career management decisions. The business I've been working at full-time and breaking my back over, I get to the end of the year and I made $30,000. Is that really the best way for me to make a living? Maybe I should just roll up shop and go get a job working for a Fortune 500 company or some other larger employer in my area who's going to pay me a little more money and have a little less stress. So is it good to be self-employed? Am I making enough money to make that worthwhile is a question. Also, to manage the money and to live a financially secure life, you need to know how much you're making so you know how much you're spending and that you do have some control over your financial affairs. And, of course, another reason to keep good records is so that you can save money on your taxes. If you can't prove an expense, you're going to have to pay tax on money you never made, and that's never a good deal. So what kind of standards do I advise my clients on for record keeping? Well, the first advice I give to them is to never pay cash for anything. I know I just told you if they have to pay cash to have a receipt envelope in the car, but the best situation is they don't even have to go to that they basically are always using a credit card, a debit card to make their transactions, or a check. They should keep a separate bank account for their business and their personal. There's no law that says they can't mix business and personal for self-employment purposes, but it's a very bad idea. It's a bad idea because it makes it all the more difficult to sort out what your income is and what your expenses are. And at least if you only make deposits for your business into the business account and you only ever take withdrawals from your business account for legitimate business reasons, then the bank account itself can be a method of tracking income and expenses. But when you start mixing business and personal, it becomes impossible. And the same rule goes for credit cards. If you have 3 or 4 different credit cards, set 1 or 2 aside to use only in the business and set the other 2 aside to use only for personal, and just don't mix the two. Now there's a question here, what happens if I do have to pay cash? I already said put the envelope in your car. One of the questions I frequently get from clients is, okay, well I have all the income coming from my business and my business account. What do I live on? How do I get money out of the account? And the answer is very simple. You need to write yourself a check, call it owner draw, take that owner draw and deposit it into your regular bank account for you personally, and then you can live on it. And if the business needs money and you need to take money from your personal account and put it back into the business, call that an owner contribution and make sure in your record keeping that that is identified. Now, lots of my clients go out and buy QuickBooks. They start up a business, and one of the first expenditures they have for their business is to go buy QuickBooks. And QuickBooks really is a wonderful program. It does a lot of really great accounting stuff. It can do a great deal. My father, who is a CPA, has worked in some pretty big companies on some pretty big, complex accounting systems, some of which cost hundreds of thousands of dollars to implement, and he says QuickBooks is as good or better than any of those. So it can be a really good program, but it also is a program that can get you in trouble. If you don't understand what it is you're doing in QuickBooks, it's like not understanding what you're doing when you prepare a tax return on tax software. It can make the job of preparing a profit and loss easier, just as tax software can make the job of preparing a tax return easier, but it doesn't make it right. Whether you're hiring a bookkeeper to do your books for you, or whether you're doing your own books on QuickBooks, either way, you want to make sure that there's a level of competency there so that what comes out of the bookkeeping system is accurate. And pretty much what I do with my clients, when they say that they keep their accounting on QuickBooks and they bring me that printout from QuickBooks, what I ask for is a backup of their QuickBooks file so that I can go into it and see what they're doing. Because usually they've got expenses that don't belong in there. They might have income that doesn't belong in there. We see a lot of really bad stuff. A hairdresser, for example, brought me his QuickBooks file backup. When I got into it to look at what was in there, I saw the net profit and loss he kicked out for QuickBooks showed income for the year of around $18,000. But by the time I went through QuickBooks, cleaned it all up, put things in the categories where they belonged, got rid of personal expenses that weren't really expenses at all, his profit ballooned to $40,000. The QuickBooks was virtually worthless. He didn't know what he was doing, and what QuickBooks kicked out was of no use to me as a tax preparer. I had to go in and clean it up. And it would have been so much easier if he just brought it to us to do it correctly from the beginning. So one of the ways I recommend my clients keep their business records is to just avoid QuickBooks altogether. They may not be big enough to require it. They may not have the money to pay a bookkeeper who's good to do it correctly. Maybe they should just avoid it then. And instead do the old-fashioned system where you have manila folders and you put receipts in those manila folders, and then at the end of the year you run a tape. It's really old-fashioned, but it works great. For an IRS auditor, they're going to come in and they're going to want to see corresponding receipts that total to the line deductions on Schedule C. And if you've got all the receipts in neatly defined manila folders, if you're ever audited and you present all of that to the IRS, they're going to be quite happy with that. And I would say that is what I've got to say about that. Let's go back to the very, very last page of this session where we have a cutout from Publication 453. And Publication 453 talks about record keeping on page 27. And on that page, I copied this table. And this table shows you the types of record keeping that the IRS requires for certain types of expenses. Any expense you ever claim on your business needs to be documented in some way. But these particular expenses for travel, entertainment, gifts, and transportation require more than the normal level of documentation. The IRS says with regards to travel, you need to keep not only track of the amount, but you also have to track each trip separately. And you also have to track the amount you're paying for lodging and meals and taxis and all of those things separately. Your travel should indicate the dates you left and the dates you returned and the number of days you were gone and spent on business. There should be a destination that is described so you know where you went, how long you were there, how much time you spent at business, the purpose of the business, the relationship of the people that you were traveling to, if there is any relationship. For entertainment, they want to know the cost of each separate expense, including incidental expenses, the date of the entertainment, the name or address or location of the place the entertainment took place, and the business purpose for that particular expense, including the names or relationships of other people who attended the entertainment with you. Gifts, the IRS wants to know the cost of the gift, the date of the gift, a description of the gift, and then all of the same information here that was relating to entertainment. For transportation, they want to know each separate expense for the car, the cost of the car and any improvements, the date of the expense, your business destination, and the purpose of the business trip. And all of that would be recorded in a mileage log. So that concludes the lecture on self-employment income. We did cover a lot today. Thank you so much for hanging in there with me. Now that we're done with the lecture, let's take a look at the classwork assignment. And the classwork assignment is actually a pretty good assignment for preparing you for the typical type of client who probably is going to walk in the door without the greatest records in the world, and you're going to have to think your way through how to prepare their tax return. And in this case, I'm referring to a home daycare business. And most home daycare businesses are pretty amateur and pretty lacking in their records. And so you're basically sorting through what kind of income and expenses they can give you, making some decisions about how to take deductions, and entering them on the tax return. And in this case, we have a character named Snow White, and she runs a child daycare business from her home on Huntsman Place, and she is licensed by the state. Snow White was widowed in 2011 and has not remarried. Her two children, Grumpy and Happy, lived with her all year. She paid $2,575 for family health care premiums. Snow White had the following income and expenses for 2012. Income from childcare of $60,000, and expenses included food for the children $3,200, toys for the children $1,200, video game machine of $150 that was purchased on October 15, outside play equipment that was purchased on November 15, and then she had the following expenses related to the household as a whole. She paid $8,000 in rent for the year, $200 in utilities, and maintenance was $300. Snow White's house is 1,800 square feet in size, and she allows the children to use all of the rooms in her house except her bedroom, which is 200 square feet in size. She cares for the children in her home 8 hours a day, 5 days a week, and she closes her daycare for 2 weeks each year when she goes on vacation. So your job is to take all of those numbers and work out how many hours in the year the children are in her home, because you're going to need to enter the number of hours that the children are in the home on her Form 8829. And the client doesn't know how many hours children were in the home. What you can do is figure out how many hours in each week that the client had the children in the home, and then figure it out using kind of logic and common sense. Car expenses: gas was $1,100, interest $1,200, and repairs were $500. Snow White paid $7,000 for a 2007 Dodge Caravan to use in her business back in 2011. The 2007 Caravan was purchased to replace an older 2002 Plymouth Voyager Snow White had been using for her business since 2009. She drove the car 15,000 miles during 2012. 2,000 miles were business miles. On 1/15 of 2012, Snow White sold her 2002 Plymouth Voyager for $1,500. Snow White had accumulated the following mileage amounts during the years she owned the Voyager. And it's showing you the mileage for each year. And your job would therefore be to total up the number of miles driven each year that are business, the total number of miles that are personal, and obviously 1 + 1 equals the total for the year. And you're going to need to use that information to figure out the percentage business use on that vehicle over time. And just up here where I say she drove 15,000 miles during the year, all of that is on the new '07 Dodge Caravan, and she did not drive the older 2002 Plymouth Voyager at all in 2012. And finally, she claimed the standard mileage allowance for all 3 years that she was driving that older Voyager. And she originally purchased that Voyager on 1/31 of '09 for $4,000. Go ahead and prepare her tax return. So at this point, I am going to pull up the answer key just so my live students can see what we had to say about Snow White's return. And I'm going to give you basically a verbal description of some of the things you need to be thinking about with regards to Snow White's return, show you a few of the numbers that we calculated, and then we'll look at the forms together. So firstly, with regards to the 1040 form itself, Snow White was widowed and she has qualifying children. Therefore, her filing status will be qualifying widow with dependent child. She could also qualify for the head of household filing status, but she's going to benefit more from the qualifying widow status. And because she's filing as a qualifying widow, we need to be sure that we write 2011 in the space next to box 5 to indicate the year that her spouse died. Snow White has 2 dependent children, and they both qualify for the child tax credit. Moving on, we have a list of all of the business expenses. If we go down here, we can see that one of the expenses on that list was car loan interest, but we're going to have to figure out the business use percentage on our vehicle. And when we do that, we determine that the business use percentage is 13.33%, and that means she's going to be allowed to claim a deduction for 13.33%, or $160 of the interest that she paid on her car loan. We have on line 22, which is the supply line, the total expense of $4,400, and that comes from the cost of food and toys that she purchased for the children. One of the forms that you need to prepare for Snow White is Form 4797, and the reason that form is required is she used an asset in her business that was subject to depreciation. And if you weren't here for my depreciation class, you may not actually know that part of every mile of the standard mileage allowance is for depreciation. And so she is considered to have claimed depreciation on that vehicle, and so she's going to need to complete Form 4797 to report her cost in that vehicle, the depreciation claimed on that vehicle, the sales price of that vehicle, and then she's going to realize either a gain or a loss on the sale of that vehicle. And of course, the vehicle that we're talking about is the sale of that Plymouth Voyager, and we figure the basis she has in that vehicle as follows. Firstly, we look to the tax year, and we look to the number of business miles driven, and we also look to the personal miles driven, and we add those up. And for each of those years, we have 11,000, 10,000, and 9,000 of miles driven for the year. So the total miles driven for the year is 30,000. And the business miles driven for all 3 years is 7,500. We divide 7,500 business miles by 30,000 personal miles, and we end up with 25% business use on that Voyager for the 3 years that she was driving it. If she purchased it for $4,000 and we multiply that by the business use percentage of 25%, it means $1,000 of the $4,000 purchase price is allocable to business use. And if it sells for $1,500 and we multiply $1,500 by 25%, it means that $375 of the sales price is allocable to her business. We then look at prior depreciation for each of the years, and we can see that the business miles in 2009 were 3,000. The portion of the standard mileage rate for 2009 that was depreciation is 21 cents per mile. So we're going to multiply 21 cents by 3,000, and when we do that, we get $630 of depreciation that was claimed in the year 2009. Using that same formula, we come up with $575 of depreciation for 2010, and for 2011, we have $440 of depreciation. Total depreciation claimed on that vehicle is therefore $1,645. So you can see here that the business depreciation claimed is actually more than she has cost in the vehicle. So she's actually going to have a sale or realize a profit on the sale of that vehicle. So we have a cost in the vehicle of $1,000, a depreciation claimed of $1,645, and a sale price of $375. And ultimately that means that she has sold her vehicle at a gain, and she will need to recapture the depreciation on that van to the extent of her gain. She has sold the van at a gain because using the standard mileage allowance has allowed Snow White to reduce her basis in her van technically below zero. Now the IRS says you can never reduce basis below zero, and I have talked with IRS auditors on this particular illustration in the past about even though you can't go in basis below zero, how is it that our standard mileage allowance is adding up in the way we figure depreciation, putting her on the depreciation schedule in such a fashion that she is selling with negative basis. And essentially what my IRS auditor told me, or the auditor I spoke to, is even though her basis percentage puts her basis at $1,000 for business use, her overall basis really is $4,000. So she hasn't claimed more than her true basis in the vehicle, but she's claimed more than the basis as we allocated under business use. And then on to business use of the home for Snow White. We're going to claim the following expenses on Form 8829. We're going to enter the 1,600 square foot area of the home that is used for business, and we're going to also enter 1,800 as the total square footage of the home. If we divide 1,600 by 1,800, we get 88.89% of the home is used for business. Since Snow White uses her home for child care, we then must complete lines 4 and 5 as follows. Snow White is open 50 weeks per year times 5 days per week times 8 hours per day, and that means she is open for business 2,000 hours out of the year. 88.89% of her home is used for 2,000 hours out of the year. And if you take the total number of hours in a year, which is 8,784 hours in a year, and you divide that into the 2,000 hours that she used the home, you get 22.77%. 88.89 times 22.77 equals 20.24%, and essentially that means she's going to be able to deduct 20.24% of her home office expenses for the overall indirect costs of her home. And so when we get to the 8829, I'll show you how all of those fill out. For depreciation, the video game machine and the refrigerator do need to be entered on the 4562, so we're going to do that. Snow White will take a Section 179 deduction for her asset purchases during the year so that she can maximize the deduction she's claiming on Schedule C, and so we will fill out Form 4562 to accommodate the Section 179 deduction. Also, she's going to have to complete Part 5 because she has listed property in service in her business during the year. We're going to need to enter acquisition information about that video game machine. It is a recreational device used for entertainment or amusement, and so that does need to be entered as listed property. The video game machine is listed property, depreciated over 5 years. The refrigerator is 7-year maker's property. And on the Dodge Caravan, we're going to have to list 13% business use for the Dodge Caravan. It is listed property. All right, then. So I did want to point out, though, that if you take a look at the two assets that were placed in service during the year, we have the video game machine and we have the refrigerator, and both those assets were placed in service in the final quarter of the year. And since they were placed in service in the final quarter of the year, the mid-quarter convention is going to apply to them. And on 4562 Part 5, Section B, we need to provide information about the automobile. And so we enter the information we've calculated for the amount of the mileage deduction that we're claiming, and we also answer all of the relevant questions in that section. And here is Snow White's tax return. You can see again that we've entered her filing status as qualifying widow with dependent child. The year of death of her spouse was 2011. The two children are listed as dependents, and they are both qualifying children for purposes of the qualifying child tax credit. Total exemptions claimed is therefore 3. We follow over and look at line 12, and we can see that net business income is $51,910. And so we'll tell you in just a minute how that was calculated. We also see that there's other gains or losses. So when we look at Snow White's basis in this minivan, we can see that she has a business basis of $1,000. She has $1,645 of accumulated depreciation, meaning that the depreciation she claimed has exceeded her basis by $645. She sells it for $375, so you're going to add $645 to $375 to get her gain. And moving over to the 1040 return, we can see that we've entered the total of those two amounts, $1,020 on her return, as the amount of gain that she has. Moving on, we also see that she has claimed a deduction for half her self-employment tax, and she needs a Schedule SE to show how we calculated that. And then we also have the self-employed health insurance deduction that we've entered on line 29. And just a reminder, the self-employed health insurance deduction is entered on line 29. It is not claimed anywhere as a business expense on Schedule C directly. We do show that the total income tax for Snow White is $2,636. Her child tax credit is $2,000. Her net income tax is only $636, but we'll see when we do the Schedule SE that her self-employment tax is $63.76. So ultimately, she actually owes quite a bit of money, $7,000. Here is Snow White's Schedule C. We can see that we've entered the gross receipts at $60,000. In the upper section, we've indicated her accounting method is cash, that she materially participated in her business, and we're saying no, she wasn't required to issue any 1099 miscellaneouses this year. Her car and truck expense is entered at $1,110. Depreciation is entered at $700. The car loan interest is $160, and the cost of food and other supplies for the children, their toys, is $4,400. Now you can see that we've totaled up all of those expenses on line 28. On line 29, we have the tentative profit for the business, which is $53,630. The next step is, because she has a profit, she can claim her home office expense in full. We need to do an 8829 to show how we figured that, but when we do that, we get $1,720 as the total expense, leaving her with a net profit of $51,910. That carries over to line 2 of what is her Schedule SE is the next form. So we enter that on line 2, $51,910. We multiply that total by 92.35%. When we do that, we have a result of $47,939, and we're going to multiply that by 13.3% to figure her $6,376 of self-employment tax for the year. On line 6, we are allowed to claim the employer portion of her self-employment tax, which is 57.51% for 2011 and 12. For 2013, it will revert back to 50%. But for this year, we end up with $36.67 that she's allowed to claim as an adjustment to income. On to Form 4797. 4797 is a form we cover in great detail in a course called Sale of Assets. And so for today, I'm not going to spend a lot of time explaining the reasons or the whys of the form. I'm just going to show how we filled it out. On line 19, we've entered a description of the property, the date acquired, the date sold. We show the sales price. We show the purchase price. We show the accumulated depreciation, which I've already explained, and we end up with the adjusted basis, which in this case is a negative number. And we then figure our total gain, which is going to be $63.75 of sale price plus the $645. That's the $1,020. It carries to page 1 of the 4797 and then on to line 14 of Snow White's 1040. Moving on to Form 8829, we're showing the total portion of the home that is used for business, 1,600 square feet. We have the total area of the home at 1,800. We have 88.89% of the home being used for business. 2,000 hours during the year that home was used for business. It's available for business 8,784 hours out of the year. So we end up with 0.2277% of the time available is used for business. We multiply 22.77 by 88.89 and we get 20.24. The next step is to enter the expenses that Snow White had. She had $8,000 in rent, $3,000 in utilities, and $200 in repairs. We add all those numbers together, we get $8,500. Multiply 8,500 by the business use percentage of 20.24, and we get 1720. The 1720 carries to the Schedule C. And moving on to the 4562, the first line on here has to do with the Section 179 deduction, which is being claimed on the refrigerator. And so we enter the description of the refrigerator, the cost of the refrigerator, the amount that is being elected as an expense under Section 179. You'll notice up here on line 2, it says the total cost of all property placed in service during the year. That is the video game machine plus the cost of the refrigerator. And we're going to actually claim a Section 179 deduction on the video game machine as well, but that is entered on page 2 in part 5, and we carry the $150 cost of the video game machine over from page 2, and we enter that on line 7. $550 plus $150 is $700, and that is the amount of Section 179 deduction that Snow White will claim for the year. That number carries down to line 22, but of course we need to do page 2 of this form as well. On page 2, we start by entering the description of the listed property for which a deduction is being claimed. We enter the acquisition date, the percentage business use, and the elected Section 179 cost at $150. We also have to enter the business use information on that vehicle, and that is 2,000 business miles, 13,000 personal miles, and 15,000 total miles. We answer the appropriate questions on the vehicle use. We have some overflow statements in here that are part of the answer key and just used to help you understand where we ended up with numbers that appear on tax forms. So if you have questions, just look on the overflow statement. You'll probably find a description. And then finally, we have the depreciation schedule for Snow White. It shows the video game machine, the refrigerator, the fact that we are expensing both assets, and the total depreciation down at the bottom that we are claiming for the year. So that concludes the review of the classwork answer key. Just one more thing to point out before this class ends. The homework assignment is a fairly sophisticated one. It involves preparation of a complex Schedule C for a character named Jean-Luc Picard. And we have provided information for his asset acquisition costs for the year. He's purchased a new business, and your job is to read through this problem and then take a look at the profit and loss that we have provided for you, including the cost of goods sold, and prepare a tax return for Jean-Luc Picard. Keith is commenting that in 2013 we have a surtax from Medicare on upper income filers. Yes, that is true. There's going to be an additional Social Security tax, or Medicare tax rather, that's going to be assessed on high income filers. And it will be assessed on investment income as well as earnings from self-employment and wages. Your question is, does it have a minimum percent expense for Schedule C? For example, for a restaurant, the food cannot exceed 31% of gross income. There's no law that says that I'm aware of. If your food expense is too high, then that would probably mean you're not making any money. And if your cost of sales is disproportionate, it would be very difficult to make a profit. I suppose if you have a food expense that's really high and disproportionate, the IRS could come in and try and determine how much of those groceries are going home and being eaten and being written off as a business expense. But there's no percentage where the food expense has to be this percent or the utility expense has to be that percent. You're supposed to go off the actual amount that was paid. Thank you for participating in Pacific Northwest Tax School's training programs. We hope to see you again soon. Bye-bye. Crater Lake. Craterlake. Crater Lake.